Okay. Scott Forehand, we're here for Debt Free Life. It is 5:37 p.m. on the 8th of April, 2021. And let's just jump right into it. So let me go ahead and share this screen. So we're here today to talk about Debt Free Life. And Debt Free Life is really, it's a proprietary system that's become available through Symmetry Financial Group and also Quility. It is a proprietary solution to eliminate debt in rapid fashion, create a retirement program like none you've ever seen. Certainly not have to worry about market oscillation like you do with a 401 or a 403 or a TSP or any of those types of retirement vehicles. And really just put yourself on the straight and narrow. When we look at this country and the founding fathers, when they created this country, both the instruments that allow us to get into debt were created, but that was where we are now with that debt clock that I just showed you. We are nowhere near, ever near where we should be, and this is definitely not the goal for the people that founded our country. So, what is Debt Free Life? What Debt Free Life is? It's a battle plan to defeat debt. And most of us here that do these Debt Free Life programs, whether you're with Quility or Symmetry or both, this has kind of become a mission in our life. This is a reason why we do this business. And every time I'm able to retire someone's $1 million worth of debt, which is very common, I have a gain, a personal gain, a personal victory, and I celebrate. So if you're here for the first time, welcome. Most likely you are either someone that I invited, one of my potential clients. You may be one of our agents here at Symmetry or Quility. You may also be potentially a client from one of the other agents here at Symmetry or Quility. Whatever the reason why you're here, whoever invited you, welcome. We're going to go ahead and get started and get some knowledge going. So, Debt Free Life. So the two main questions that we ask, and I don't know anybody who's ever been able to answer these questions, not the way that we would expect you to, but are you 100% certain that you're going to have a great retirement, or do you have some doubt? I think everybody has doubt. And if we could show you a way to get out of debt in 9 years or less, including your mortgage, would you, without spending any more money, is that something you'd be interested in? And of course, everybody's interested in that. But I just wanted to get some clarification. That last statement, 9 years or less, that's really inaccurate. It's really much broader than that. And what I've found is it's actually 15 to 27 years early. So if you've got someone with a 30-year mortgage, for example, I've had one of these programs work on a client that got them out of debt in 2.6 years just by spending money a different way, spending it more efficiently. And that's what Debt Free Life is. It's about spending money efficiently. Spending money that you are currently spending inefficiently, putting it into a situation where it will work for you continuously. If you're the average American, the one who's participating with that debt clock we saw earlier, then this really looks like you. About 40% of every dollar you make, 40 cents on every dollar, are spent on taxes, whether it's an immediate thing in the form of gasoline tax, food tax, property tax, or something that's delayed when you pay your income taxes. Whatever the case may be, about 40% of your income goes to pay for taxes. And when you look at again, going back to the founding fathers of this country, they had no intention ever. That's why we were founded. It's because there was too much tax. Interest rate, 34%. That's the average amount of interest you're going to pay out of every dollar that you earn, which means between taxes and interest, you're spending almost 3/4 of the amount of money that you make. And that's insane. And yet we continue to do it. And yet we go out and buy more stuff that we have to borrow money to buy. So we're going to show you a different way to do that. And I'm not saying stop buying stuff. That's not what I'm saying at all. But if you could buy something with an interest rate of 12% on a credit card, or buy something with a 0% interest, you're always going to use the 0% interest. And that's what we're going to show you. The other thing is, what we look at is we are routinely saving a percentage of our money. And for those of you that have retirement income accounts set up, 401s, 403s, whatever, you may be in that situation where you're contributing or putting away 2%, 3%, 5% of your income. And maybe you're getting a match from your company, and that's great. But don't have any illusion. The money that you're putting away for a rainy day, that 2%, 3%, it's not enough. It's not going to make it. Even with the match, it's not going to make it. And if you think for a second that Social Security is going to be there to bail you out, you need to rethink that. The last thing we're looking at here is the lifestyle money. And that's what you live on. That's the amount of money it takes you to pay your car payment and make your mortgage payments and put food on the table and keep the power bills on and all that stuff. And if there's anything left over, you've got a little bit left for entertainment. Maybe you read a book, maybe you buy a book, maybe you watch Hulu, Netflix, whatever. That's it. So where we have come to is we have come to value stuff, which it's not a bad thing. I like stuff, but to the detriment of our financial future. And that's what this is about. That's what debt-free life is about. It's about putting you back on the right track without you spending any more money than you're already spending. And that's the magic here. So the average American makes plenty of money in their lifetime. The average American makes, as you see right here, about $2 million. The majority of that is made in the last 10 or 15 years of their lifetime, just FYI. So when you're looking at this solution, the earning years, ages 50 to 65, those are the heaviest earning years possible. So if you're late to the game or think you're late to the game and you're 50 or 55 years old, or even 60 years old, or even 65 years old, and you don't have that nest egg built up, fear not, there's a way to do it. I've done it. I've done it with Debt-Free Life. I've done it for people up to 75 years old. So there is still a solution and there is still time, and it doesn't take a lot of time, especially when you're at that high earning level. That little number down there, out of $2 million, the average American, remember that pie graph before, 3% for retirement? Yep, that's 3%. So if you've made $2 million in your lifetime, all of a sudden you're ready to retire, and your retirement is that 3% that you saved, plus whatever Social Security is gonna dribble in for you. Guess what? Your circumstances, your living circumstances are going to change drastically, and we're talking about 40, maybe 60% drop in income level, but you're still going to have the same bills. So that question, is this the American dream? Of course it's not. And that's something that we can fix, and it starts today. So when you get that realization, that sinking feeling that maybe you've got too much debt, you start Googling stuff on the internet, you start talking about debt consolidation and refinancing the debt and looking at debt counselors and what they're going to tell you to do. And those bullet points on the right are the common things they're going to tell you. And I'm going to tell you that every single one of those will fail, except that debt snowball, as long as it's a true debt snowball. You can only work harder for so long. You can only eat so much ramen and tuna fish. Save more? How can you save more when you're spending more than you make in many cases? Refinance the debt. So I'm going to transfer one debt for another debt. You're going to pay that shell game with get the 0% interest credit card for 12 months and then run it up and then go get the next 0% interest credit card. That shell game, the debt shell game, that doesn't work. And then consolidating, and a lot of people that are out there, especially debt counselors, if you have assets like a home, they're going to advocate for you to take a home equity line of credit out. And I'm going to tell you, stop. Why would you transfer ownership of your home and leverage ownership of your home to someone who doesn't have any right to your home? Why would you take out a home equity line of credit to pay off a credit card? That credit card can't touch your home. That home equity line of credit can. So why do that? So I'm just going to say stop. Talk to whoever brought you here. Look at a debt-free life program. Get on the straight and narrow. Okay. Lastly, that word debt snowball. Let's talk about that for a second. There are some other folks that have been out there before us, and they've used other vehicles to try to approximate what we've done, what we're doing with debt-free life. And in all those cases, they all have an Achilles heel. They all fail for some reason. And that's what we've done here. We've created the solution that will not allow you to fail as long as you follow the system. And the one thing that we do that you will see that most of these other programs will have as well is the words and the phrase debt snowball. But I want you to be very clear. What we do is a true debt snowball. A lot of times what people think of as a debt snowball is figure out what the most highest interest rate thing is first and pay that off, and then do the next one and the next one and so on. That is not debt snowballing. That's called debt stacking, and it is inefficient. There is only one best way to eliminate your debt. There's only one way you can do it with all the different variables and all the different debts you have and all the different income you have. There's only one best way to get you to the end of the line with the most amount of money. There's only one way, and it uses debt snowballing, not debt stacking. Moving on. So our better way, this is what we're here to talk about. 9 years or less, 15 to 27 years early. So I've done these programs on people that the only debt they have is a mortgage, and their mortgage is 30 years. And we've gone through, done the analysis, and we've eliminated that 30-year mortgage in 15 years without them spending any more money than they're already spending. So it works for everybody. And before you think for a second, wait a minute, what if I don't have any debt? Great. That means you're starting off in phase 2. And we'll get to that in just a minute. So what our goal is to change the paradigm, change the equation, change the argument from where you are right now, which is the left side of your screen. Average household debt of 250. I got to be honest with you. I did 101 of these programs last year, and maybe 5% were under at $250,000 in debt or less. It is not. That is not an accurate number. It's much higher than that, unfortunately. But regardless of the amount of debt, we want to move you from the left side of the equation to the right side of the equation. We want to change the argument, change the paradigm, change your future. We want to make it so that you're not going to spend 40 cents of every dollar on taxes. We want to spend 30 cents on every dollar on taxes. Some of it you're just not going to be able to avoid. We want to make it so that you're not saving just 3% of your income for a rainy day. We're going to save 15%. And through the effect of compound interest, that 15% is going to allow you to retire at your current income level, which is great. Work 90% less, get paid the same, sign me up. Okay. We're going to increase the amount of money that you save for retirement. We're going to decrease the amount of money you spend on interest. We're going to go from 34%. We're going to have a 40% reduction in interest payments down to 23%. And then the most critical part of this whole thing is I know that if we put you into a program where, like a lot of those other debt consolidators are going to do and tell you, you're going to get pretty tired of never doing anything fun. You're going to get pretty tired of, instead of reaching for a steak every once in a while, eating nothing but hamburger. You're going to get pretty tired of not doing the little things. So our goal is not to reduce your income level and your cash flow. Our goal is to increase your cash flow. And going from the left side of the screen to the right side of the screen, that 23% to a 33%, the simple math is 10% gain. Nope, it's not 10%. It's a 43% increase in lifestyle money. So I ask you this. If you're currently in a situation where at the end of every month, you've got $1,000 left over in your checking account, and all of a sudden I said, hey, wait a minute, there's a better way. Let's spend money a different way. And by spending it differently, not making any more money, not spending any more money, just spending it differently, I'm going to make it so you've got $1,400 left over in your checking account every month. That $400 is a big deal. That's the difference between, instead of not taking a trip a year, that's the difference between taking 0 trips and taking one $5,000 trip or taking two $2,500 trips. It's a huge change. It's the difference between waiting 2 years to buy the new car or going to buy the new car now. It's a huge change. And that's what we can do for you. And that's what those of us that run these programs and do these programs and illustrate these programs, we do this every day, day in and day out. There's no magic here. It's just math. I've said that before. I'll say it again. It's true. The math doesn't lie, and it's contracted. So how do we do it? We're going to reduce the amount of interest you pay over time. And I'll show you how to do that in just a second. Our goal is to eliminate all your debt in 9 years or less. I've seen it much faster. That's dependent on a couple of things. So just as a preview, if you've got someone with $100,000 in debt, that's one debt, which is a mortgage, versus someone's got $100,000 in debt, which is 7 debts or 8 debts or 10 debts, which are credit cards and personal loans and all that other stuff, the person with the multiple debts is going to win. It's going to get paid off faster because of the debt snowball. Just there's your preview. Reduce your taxes over time. So right now, if you've got a TSP, guess what? When you start taking your TSP money, you're going to pay tax, and you're going to pay a higher tax than you're paying right now, because that debt clock showed us earlier, taxes are going up. The current administration already said on day one that they're going to increase taxes. We know it's got to happen because they've been kicking the can down the road for a long time. They've got to rescue Social Security. The baby boomers are not getting older, and they're not getting any cheaper to insure. We're going to have to rescue Medicare. We have to rescue Medicaid in many cases. It's all going to come, and it's all going to come at the same time, unfortunately. So yeah, taxes are going up, but what we're going to do is we're going to reduce the amount of taxes you pay over time by reducing your tax exposure. And that's the trick here. We're going to improve your cash flow. We already talked about that. And we're going to allow you to retire with a tax favored income. So for me, there's the most tax favored of all kinds of tax favored incomes is the one where there is zero tax. And that's exactly what this program is. By default, there's zero tax when you retire on the monies that you pull from this program. So I told you before that there are other programs that have been out there before us, and they've done well, and many of them, well, actually all of them fail usually within 12 years. And sometimes it's a discipline issue. Sometimes it's because of something you didn't see, but most commonly across all the other programs that have been out there before us, the common reason why they fail, because they don't plan for the unexpected. And, you know, it's one thing to assume that the market is going to have a gain every year, 12 years in a row, which is what one of the most common programs out there assumes, which is not the case. And it's another thing to assume that no one's ever going to get sick, no one's ever going to get hurt, no one's ever going to die early. All those programs that make those assumptions fail. Our program takes both of those pieces into consideration. And if someone dies too early, the debt's gone. If someone gets sick, injured, disabled, doesn't die, the debt's still covered. So we've got those little pieces in place to protect against the what ifs and I didn't think of that. We got it covered. Moving on. So I mentioned a minute ago about a tax advantaged program. You know, what's the most tax advantaged program as far as retirement is concerned? And that would be the one where you don't pay any taxes, right? So if you map out 3 separate retirement programs, one being this program, which is a tax exempt program, one being a tax deferred program like a 401 or a TSP, and one being a taxed program like a Roth. The differences in the return is illustrated. This is the same amount of money invested for the same number of years at the same interest rate at the same tax rate. There's no variable here. They're all going to be applied the same responses, the same result. The difference is if I pay my tax now on day one and I put it into a program that is never going to be taxable, then it outshines a Roth, and then taking into consideration that this program, because of where it's structured, I'm not limited by my age as to when I can access the money. I don't have to wait for the CARES Act to come up to give me access to my money that I need now. I don't have to prove a hardship to take my money before I retire. And more importantly, when I'm 72 and I don't need the money, I'm not going to be forced to take the money and forced to pay a tax on it. Like every single retirement program you have that's out there right now, required mandatory distributions. We don't have that here. So when you compare apples to apples using those parameters, and it doesn't matter, you can change any one of those variables. It's still good. It's always going to outperform an IRA or a Roth, always. The math doesn't lie. So I mentioned earlier that you have people that maybe are looking at this as not necessarily a debt elimination vehicle, but maybe as a growth and retirement vehicle. Great. And that's what I said earlier. So this vehicle, like most financial instruments, has phases of operation. And the phases are maximization, accumulation, distribution. And the difference is this. In the maximization phase, you have debt. And the debt is evil. It weighs on you. It causes anxiety, causes problems with interpersonal relationships. It certainly deadens the feeling of safety and comfort when you're thinking about your retirement. Debt's a killer of many things. So if we can change the discussion and change the paradigm so that we're no longer focused on the negatives of debt, but flip it on its head and make the debt work for us instead of against us, well, that's a different day. That's a different side of the bed that you wake up on. And things are a lot rosier. And things are a lot prettier than they were before. The smells are better. You know, the food tastes better. The time you get to spend with your family feels better. When you get that heavy weight lifted and gone, and you have conscious thought and conscious knowledge that your future is safe and is set, and the government can't do anything to make it a problem for you. Okay, when you get to that point, then the whole world opens up, and that's what the debt-free life program can do for you. The maximization phase, we're going to eliminate your debt. We're going to eliminate it many, many, many times faster than you ever thought possible, and also in a manner that you've never considered. We're going to get you to that second phase as quickly as possible, which is the accumulation phase. That's where we are accumulating wealth. We are making our wealth and our dollars work for us instead of working for our dollars and our wealth. And then eventually we're going to get to that point where we're at the distribution phase. That's when we're retired if we want. Or maybe the distribution phase is going to happen in 2 years when I want to buy that boat. I don't know. It's up to you. It's your program. But the point is that we're going to get you to the point where you have that option, the choice. You can do it if you want to do it. It's up to you. That's the double-edged sword with the debt-free life program. That is the only drawback of a debt-free life program that I've been able to find, which is in order for the program to work, you have to follow the program. So if you're out there and you're running around the racetrack and everybody's making a left-hand turn, making another left, and then making another left, and all of a sudden you want to take a right, you're not following the program, and you're going to crash and burn. So our goal is to get you through this program as quickly as possible, get you to the accumulation and eventually the maximization phase. And we're going to take the money in the distribution phase, we're going to take it without taxes. We'll talk about that in just a second. So I mentioned that this is not new. This is really, there's a concept called infinite banking. It's been around forever. This is what the Rockefellers did, the Rothschilds did it, the Chases did it, Wentworth did it, all those old school families, those old school financial families that form the basis of our financial stability here in this country now. All those families use these programs to do this. And the people you see up on your screen, they all used them too. This is nothing more than the creation of a private bank that we own, we control, and we're the banker of it. And previously, in order to do this thing with regularity, you had to have a large chunk of change to start these programs. Not anymore. Not as of May 2019. So you're living in a great time. So now this big, massive program that only the wealthiest could perform in is now available to all of us. So welcome. So how do we do it? I've already said this. We're going to redirect any inefficiently spent dollars. So if I like Starbucks, that's an inefficiently spent dollar. But this isn't just about trying to trim there. That's just a tiny part of it. If I'm paying my car payment and I pay that car I send my $500 in for my car payment. Where's my money? It's gone. There's a better way to do it. We're going to grow cash value. And this is not a question. This is not a, and we're going to grow cash value. No, we're going to grow cash value. How are we going to do it? We're going to do it by contract. So Einstein is purported to have said, there's nothing more powerful in the world than compound interest. And so where debt and amortization and interest rates and compounded interest work against you in the form of credit and loans, we're going to reverse that and we're going to make it work for you. You're going to become the banker. You're going to become the decision maker of whether or not, if you want to borrow money from yourself, you decide whether or not it's a good reason to borrow from yourself. So what are the key things there? Bullet number 3, we're going to borrow from the policy's cash value without penalties or tax. That's why this system works the way that it does. That's how we are able to skirt the whole taxation issue. Because when you set these programs up and we start executing them and start working through the system and start following the plan, we're going to take money out, but we're still going to be making money. And we'll show that to you in just a few minutes. All your debts in 9 years or less. If you looked at your amortization schedule when you bought your home, that thick stack of documents, you were shocked, hopefully, to find out that your first mortgage payment wasn't the 3% they quoted you. Your first mortgage payment was actually 74%. So if I can eliminate the time where you're paying much higher interest rates with every payment than as advertised when you take the loan out, then I'm going to save you a ton of money, or the system's going to save you a ton of money. Or the truth is, you're going to be saving you a ton of money. So cash flow, talked about that earlier, going from $1,000 to $1,400 a month left over every month. What do you do with the money? Well, you can go spend it, have some mad money, have some free time, or really ramp up your debt-free life program. Put that extra $400 into this every month and watch your money grow. So last thing I'll say is this, that last bullet. At its core, this is a life insurance policy. It's a very specialized type of life insurance policy, but it is still life insurance. So in the end, when we look at this, that's how we protect. We're not doing this with a home equity line of credit where you're giving away equity in your home to eliminate some debt. We're doing this through loans from a life insurance policy that grows faster than the interest we're being charged to borrow the money. That's called positive arbitrage, and you should learn to love those words. Okay, so this program has been around since 2019. Those were some of the first families that we helped. The numbers that they've got there, they're nice, 78,000, 100,000, that's great. The numbers that I see on a regular basis is way higher than that. We're eliminating 500, 700, 1,000, $1 million worth of debt. That's not uncommon. And we can do it all in 7 to 9 years if you follow the system. So what's different about what we do? How does this work? How come you just can't do this on your own? Well, that's because you've been trained to do things a certain way, and you've been brought up that way, and you've been taught that it's okay to take on debt. You make money. As you grow older, you make more money. As you make more money, you can afford more things. As you afford more things, you buy more stuff. And your debt creeps up and up and up and up. And eventually you get to the point where you're 50, 55 years old and you realize, holy cow, I'm going to be retiring in 10 years and I'm not going to have anything left for it. Okay. So your method has gotten you to exactly where you are right now. You are exactly where you're supposed to be based on your financials, how you spend and how you save. This is how you do it. You make money. That money gets deposited in the form of a paycheck to your checking account. Doesn't matter who you bank with. That checking account, that bank is very happy to allow you to keep your money in their bank. As a matter of fact, they may even tell you, you know what? You've got over $2,000 in your bank account this month. We're not going to charge you anything to keep your money in our bank. And in the meantime, what are they doing with your money? They're lending it out every night at the federal funds rate or higher. Anywhere between 1% and 24% interest is what they're getting. And you are getting nothing for that. In the end, you come to that realization that you need to pay your car payment. So you actually write a check or transfer money or use your bill pay system or however you pay your bills, and you instruct your current bank who's holding your money and lending it out every night and making money with your money, but not giving you a penny. And you tell them to go ahead and pay that debt. And then what happens? And then your money has become their money. And your money's gone forever. And your bank held on to it. The average dollar that you put into your checking account right now is lent out 7 times before you ever get to use it. Average dollar sits there for 7 days and they lend it out 7 times. I'd rather do it differently, and I'd rather have it so that I get to use my money over and over. And that's the debt-free life method. So here's how you should be doing it. And if you're not doing it, you need to talk to whoever invited you here and start doing it this way. So you make money, same thing, whether you're W-2, W-9, 1099, sole proprietor, it doesn't matter. You still make the same money the same way. You still work your same job. You still deposit that money on the paycheck into your checking account. None of that changes. However, once the money gets into your checking account, we're going to make a detour. Instead of us allowing our bank to sit there with our money using it over and over and over again, we're going to send a premium payment to our life insurance company. And we're going to buy whole life. Remember, I told you at the core, this is just a life insurance policy, specialized, but still life insurance. This is what's called a participating whole life policy. What that means is you are able to participate with the productivity and profitability of the carrier that holds your life insurance program. Okay? So think about this for a second. Do you know any banks that have failed? Of course you do. Do you know any investment brokerage houses that are failed? Lehman Brothers, Bear Stearns? Of course you do. Can you think of any insurance companies that have failed? I can't. And the truth of the matter is, yes, they do fail, but because of the way that the insurance industry is structured, you never hear about it and nobody ever experiences a problem because of it. Because that insurance company that may or may not have failed, whose name you can't remember, their insurance programs were picked up by another carrier because they all co-insure each other. So just because XYZ carrier may go out of business, QRS carrier is going to pick up XYZ carrier's policies. And they're still going to be serviced, they're still going to be funded. So the point is, you haven't heard of an insurance company that fails, mainly because they're the most profitable businesses on the planet. So wait a minute, are you telling me that all I have to do to be able to participate with the profits of the most profitable businesses on the planet is take out a participating whole life policy? Yes. Okay. So next, you buy that whole life. Whole life in and of itself doesn't do anything for you. A participating whole life does a little bit for you. But where we do what we do, we ramp up this and we accelerate the whole process. And how do we do that? Well, we put a term life rider on this. And the reason why we do that is because that term life rider increases the amount of death benefit, life insurance, which increases the size of the life insurance for the entire program. Remember, that term life piece, that's a rider. It's not a term life policy, it's a term life rider, which enhances the insurance capacity of that participating whole life policy. So your participating whole life may only be $10,000, but your term life umbrella might be $400,000. So you have $410,000 of life insurance coverage. This is how we protect. Remember I told you we cover the what ifs. What if you die too soon? There you go. If you die too soon, you got enough money coming in to pay off all your debts. Great, right? Well, that term life does one more thing. It increases the cost of the life insurance, increases the size of life insurance. And why that's important is because of this third piece. The third piece is called a paid up addition. This is additional life insurance. It's called a paid up addition, paid up additional life insurance. That means that once you pay for it, you never have to pay for it again. So what do you call $1,000 that you have in your wallet right now? That's an asset. And how much is that $1,000 that's in your wallet right now worth tomorrow? It's It's worth $1,000. How much is it worth 10 years from now if you haven't spent any of it? It's worth $1,000. So that $1,000 you have in your wallet right now that's worth $1,000 today is worth $1,000 10 years from now. Okay? So it is an asset. Any asset that maintains its value without cost is what's called a tier 1 asset. All banks use classifications of asset classes based on risk and reward. Okay, how risky is the investment? How much does it cost me to maintain the investment? How sure am I that the investment is going to have value at the end? So if you've ever done stock trading, buying an options contract, that's highly risky. There is no guarantee at all that you're going to have any value in the end. Okay, this we know for a fact. Once you take out a life insurance policy, especially whole life, or in this case, a paid up addition, once you've paid for it, it has permanent value. It is a permanent asset. That's why there are companies out there called viatical settlement companies. That's all they do is they go around and buy up life insurance policies from people that have value in them. Okay, you got a $100,000 life insurance policy is paid up, but you want the cash now? No problem. I'll give you $60,000 right now. You sign over the policy to me. When you die, I get 100 grand. Sign me up for that all day long, right? It's a viatical settlement company. Banks know it. Wells Fargo has 48% of their tier 1 assets structured in life insurance policies. They know the value, okay? So what we've done here is we've taken some monies, backing up, going back down to my checking account. I've taken money out of my checking account. I've paid my life insurance policy. In the process of paying my policy, there's 2 riders. I've got the term life rider, which creates that massive umbrella. And I've got this paid up additions. The truth is, folks, most of the money is buying paid up additions. So even though you may be paying a premium that's $100 a month, most of it, about 68%, is going to buy paid up additional life insurance. So every time you make your premium payment, you are sequestering cash in your program in the form of an asset, a tier 1 asset, paid up additional life insurance policy, right? What are we doing? We just moved and we changed the argument. We changed the paradigm. We've moved our money out of our checking account into a private bank that we now own, we now control. And the most critical thing about this whole thing, participating whole life. I get to say, you know what? I just spent $100. About $79 of that $100 is cash value in my program. And I'm going to get a guaranteed 4% on my cash value. And some of the carriers are going to compound it monthly. More importantly, every year, year after year, as the company makes money, not only am I going to get a guaranteed interest rate, I'm going to get a dividend on top of that. Okay. So now this is an exercise about how we spend money. So right now I've spent money. Previously, I wrote my check for my car insurance payment. It's gone. I wrote my check for my car payment. It's gone. In this scenario, okay, now it's time to write my car insurance payment. What do? I take a loan. I take a loan against the value of my program. And then that money from that loan gets deposited back into my checking account. And then I tell my bank to go ahead and pay my debt. And the bank says, okay, I'll pay the debt. And then that money becomes their money. But I ask you, Ryan, or Jim, or Taylin, where's my money? My money is still sitting in my bank. I use the carrier's money to pay my debt. The debtor doesn't care where the money comes from. They just want their money. So if I can borrow money, and this is the catch, this is the kicker. If I can borrow money at a lower interest rate than I'm being paid on my money, who wouldn't do that? I'd do that every day of the week. Sign me up as quick as I could. So in this scenario, that's called arbitrage. It's called positive arbitrage. So what happens when you use a credit card, you're getting negative arbitrage. The credit card company is borrowing money from a lender to give you the money to go buy whatever it is that you want. They're charging you a fee, 4%, 8%, 10%, 20%. They're being charged a fee to borrow that money, 2%, 4%, 6%, 8%. And they're making the difference. They're making the delta. we're changing the argument, changing the paradigm. We're going to borrow money at a lesser interest rate than we're being charged. And I don't want to get into the advanced stuff about this, but you can actually get some serious difference. You can get it down to probably about 2.5%, maybe 2.3%, but you're still earning 4.2% or higher. So that's how you spend money. That's how you should be spending money. So let's look at an example about how this works for a family. So this is a standard family that I worked with a couple of years ago. It was a family. They were both previously married, so they had 2 homes in here. The wife was at this time a college student working on her doctorate, and the husband was a truck driver and drove a truck and owned his own trucking company. So with the debt that they had, the debt load they had, they knew that it was going to take them about 40 years to get out of debt. When I asked them how much debt they had, they said, I owe $584,000 total. That's not true. When you look at the interest that's going to accrue and compound over time and how much money they're going to have to pay off all that debt, their true debt was $767,000. That's sick. $182,000 of interest. So if we can save even a dollar, it's worth saving a dollar, right? So our system did a couple of things. So first off, we got them out of debt in 7.8 years. Now look, this is without them spending any more money than they're already spending. They're not going out and getting additional jobs. They're just changing the way they spend money. And we're using a true debt snowball in conjunction with infinite banking to create a scenario where their debts get paid off and get paid off quickly. And as the debt snowball grows and grows and grows, we're paying the debts off faster and faster and faster. And then we're paying off larger and larger debts, eventually getting to the point where we're paying off the mortgages quickly. Okay. So here's the true nature of their debt. In 40 years, if they'd stayed with their current program at that time, they would have been out of debt in 40 years. They would have had 100% equity in 2 homes, and that's it. Doing this in 7.8 years, they had 100% equity in 2 homes, saved $70,000 in interest. And look at that last segment down there at the bottom, where they're going to be in 40 years. Instead of having all their debts paid off with 0, they're going to have all their debts paid off with $4.8 million worth of cash sitting in their program. And even more importantly, look at that next number. Don't forget, it's life insurance, right? So not only do they have a huge cash value at the end, they also have $1.1 million of life insurance on top of that that's paid up. They never have to pay for it again the rest of their lives. So when we talk about creating generational wealth and how this is it's not just a life insurance policy. It's a wealth building program. It's a debt elimination program. It's all of the above. It's just depending on where you are in which phase, maximization, accumulation, distribution, you're going to be looking at different aspects of the result of the program. So how did it actually happen? How does it actually work? So in this scenario, in the first year, they made their premium payments. They were able to pay off $14,900 in debt in their first year. And in order to do that, they had to take $8,600 in loans. Excuse me. At the end of the year, they had paid off the $14,900 in debt down to $8,600. So they paid off $6,300 in loans. Borrowed $14,900, paid off $6,300. At the end of the year, their loan was left at $8,600, but the cash in their account was over $12,000. Year 2, they paid off another $15,000, paid off the balance of the previous year's loan and half of this year's loan, so that now they're only owing $77.93. And at the end of that year, they had $40,000 in their account. The next year, they paid off a lot more debt, got a lot larger loan, less money in their account. And the next year, and this is cool, the next year there wasn't, because of the size of the debts that were left, there wasn't enough money to pay off any of the debts. And our software looks for when they can pay off a debt. So our software could not pay off a debt in this year. So instead of paying off the debt, we're just growing. We grew to $91,000 in our account in year 4. Oh, by the way, these people are in year 3 right now. And it is working exactly as this illustration described to them. So in year 5, that's when they're paying off a big chunk. They're paying off the balance of her student loans, taking a $96,000 loan, paying down some of it, paying off all of the previous year's loans, and all at the end, still having $61,000 left over, and so on and so on. So this particular program was designed on the life of the husband because he's younger than the wife. So in this case, the husband wanted to retire at age 75 because he owned a trucking company and he was just going to run his trucking company later on in life. And he got to the point where he was thinking about buying one new rig about every 4 or 5 years. Yeah. And in the end, what he's able to do with this program is he'll be able to buy a new rig about every 2 years, maybe every year. More importantly, he won't have to wait till age 75 to retire. Even looking at age 55, there'll be $1.5 million liquid in the account. I don't know about you, but I could probably retire with $1.5 million in the bank. The interest on that alone would be about $75,000 a year. If he stops the program at age 55, look at this. So he contributed at age 55. If he continued, he would have contributed $21,000 to the program. This program grew by way more than $21,000 in 1 year. This program grew by $136,000. So if you take out the 21, that means this program with the interest rate, the compounding, and the dividend is growing at about $110,000, $120,000 a year at age 55. And that money is tax-free. Get it? Tax-free. Okay. Well, let's say, you know what? Maybe you're young. Maybe you don't have a home yet. Okay. Does this work for people without mortgages? Absolutely. Here's an example of a 23-year-old college student that I did one of these programs on. She's a master's student at Cal Poly now, getting her master's in marine biology. Doesn't really matter. But in the interest of brevity, she has a lot of student loans. And I'm going to say this, student loans are evil. Did I say that? Yes, I did. Student loans are evil. They are not nice. They're not your friends. They are evil. And she's got them. And she's got a lot of them. And the truth be told, here's the sick part. She only owes $85,000. But because of the student loans, she owes $91,000 in interest. She's going to pay more interest than she's going to pay in principal. That's sick. So instead of her being out of debt in 40 years with nothing to show for it, we got her out of debt in 9.7 years. That's paying for all of her college, her car, the vet bills that she's got, the hospital bills that she's got, all that stuff. She's completely debt-free in 9.7 years. We saved her $64,000 of interest. More importantly, at the end, in 40 years, she'll be 63 years old. If she wants to retire at 63, she can. She'll have $603,000 sitting in that program and a paid-up life insurance policy worth over $400,000. Sign me up. This program, just so we're on the same page, this assumes that she will never make more money than she makes right now. She works as a waitress. And that she will never be able to overfund this program, which of course she will, and she already is. So, the effect of compounding is great when you've got 40 years of compounding to build on it, right? So for her, same kind of deal. We're just paying off debts as we move forward. More importantly, if she wanted to retire, we said 63. What happens right now? I've got this program stopping at age 55. So at age 55, she can retire and never work again if she doesn't want to. She'll have $409,000 in the bank. That $409,000 with zero cost is going to be generating $22,000 a year of interest. That's tax-free interest, people. That means she's generating the equivalent of a $36,000 per year income without even getting out of bed. Okay? So that's the end of this basic presentation. So what do you do next? You should contact whoever brought you here and start looking at doing one of these programs for yourself. If I invited you and you got anything out of this, you should call me. It's a no-brainer to do this stuff. For every one of us, I don't think any of us have 100% confidence in our current retirement programs. I don't know that any of us have 100% confidence in our federal government, regardless of which side you're on. But in this scenario, all we're doing is we're making the federal government's rules, in this case, the IRS tax code, work for us instead of against us. Okay. So usually at this time, we'll got a few minutes. I'll take some questions. If you've got a question, you can post it in the chat or unmute yourself and ask. Anybody? Everybody got everything. Right. So you guys are ready for the quiz then, right?
Excuse me. I have a question. This is Annie.
Annie, how are you?
Just great. And you?
I'm fantastic.
Wonderful. My question is, when the money gets to the bank, it goes into the account, and you said that the program with the whole life and the term type of insurances are set up. Does that mean that these programs are set up or designed wherein it will automatically pay certain bills?
No.
For me, or
Nope.
Okay.
No, you have to. So this is so when you want to execute your program and pull money from your program, you have to do a loan. That's how it works. So but once you get the system built, it's just a matter of going into your online portal, just like your bill pay system, and say, yeah, give me $2,000, and they'll direct deposit $2,000 into your checking account, and then you spend the money out of your checking account. This does not replace a checking account. This is not a bank. Okay, it acts like a private bank. It is still a life insurance policy though. Okay, but it's a life insurance policy with a guaranteed interest rate plus a dividend plus compounding that you can use over and over and over and over again. And when you compare the combination of a dividend plus the compound interest, 17 out of 20 years, you're going to be getting more return on the money that you have in the program than the loans that you have against it. Okay. So what does that mean? Reading between the lines, that means, I get this question all the time. Do I have to pay back my loan? And my answer is, if you want to. You don't have to, because the system is designed to pay the loan back on its own.
Once you request the money, how long does it take the life insurance company to put the money into your checking account?
Good question. And just for the record, she's a forehand, I'm a forehand. That's my wife. I did not tell her to ask this question.
No, so, I offered that question up because I think that it might offer a little clarity.
Sure. So it depends on a couple of things. First off, it depends on who you bank with. So if you're with a credit union, it's going to take about 2 days longer than if you're with a major bank like a Wells Fargo or JP Morgan Chase. So it depends on the size of the bank. The carriers all use massive banks. So they're either with Chase or Bank of America or SunTrust, depending if it's a regional. So, they use big banks. The rate and speed of which your bank account shows the cash deposit is dependent upon your bank. And it's usually 2 to 4 days. Thank you.
Hey, Scott.
Hey.
Yeah. Hey, Scott. It's Becca.
Thank you so much for your help on Monday.
Yeah. No worries. Anytime. So my question is, if someone's on this plan and they die, right? They took out a loan, they died. The loan piece does that come off of the death benefit?
Yep.
Of whatever it is that they had to pay back.
Yep.
It just comes off of that. Okay. That was my question.
But don't forget, so you've got whole life, core policy, term, massive umbrella, paid up additions, massive growth over time. Your loans are taken against the paid up additions. So you're still going to have the term and the whole life, the whole life and the term umbrella as additional death benefit. You will never be able to borrow more money than you have in the program. Okay. And even then, they're only going to give you access to 90%. So if you've got $1 million cash in your program, you can borrow $900,000. And then when you die, there's still going to be the core whole life policy plus the massive term rider plus that extra $100,000. So once you set these vehicles up and structure them correctly, there's no way you're not going to be leaving a legacy. No way. All right. Anybody else?
I have a question.
Okay.
Okay. If you're a senior and you have no debt, and I think you mentioned something about you're going to explain that.
Oh.
How can you work on this?
Right. So what we do is we look for places where you're spending money inefficiently. And if you have no debt, other than like if you don't even have a mortgage, then all this is an accumulation vehicle. So rather than putting money into a 401k, we're going to get, taxed to death, or a 403, or rather than putting money, just having it sit in a savings account earning 0.25%, putting into one of these programs, you're going to earn somewhere between 20 and 27 times what you're going to get in a savings account.
Is there a minimum required to do that?
Depends on the vendor, depends on the carrier. So there's a minimum life insurance size, which is anywhere between 10 and 50,000. All right. But as far as the premium concerned, that's going to be dictated by your health. Because at the end of the day, this is still a life insurance policy. So you have to be healthy enough to qualify for it. But here's the kicker. I do these all the time, where I did one the other day the gentleman was 82 years old. He's not eligible. However, he's retired. He wants to make sure he leaves a legacy. So what he did was he put one of these programs on his grandson. He's still the owner. He's the payor. He's the beneficiary. He gets to fund the vehicle. He gets to use the money. And then when he passes, what he has done is the same thing the Rockefellers did. He has just transferred wealth generationally, skipped 2 generations to transfer wealth. And there's no tax. It's a death benefit. It's a death benefit transfer because the policy is already written on the grandson. So there's different ways to do this. And there's no one size fits all. That's why when you're doing these things, you have to be working with someone who knows what they're doing, because there's a lot of different ways and a lot of mistakes you can make when you're setting these up. But certainly, even if you're already retired, it's a great vehicle. It's a great vehicle to. I have groups they're pulling money out of their 401ks, paying the tax on it, and then putting it into this vehicle, because now they're scared that their 401ks are going to be shaken up, and they will be by what's getting ready to happen with the market. So now they can say, I don't have to worry about the market. My money's not in the market. I'm not even indexed to the market like an annuity would be. My money is in a completely different vehicle that doesn't care whether the market goes up, down, or sideways. I'm still getting my 4%. I'm still getting a dividend. I can touch my money whenever I want to. I don't have to pay tax on it whenever I do touch it. And the IRS can't tell me when I can and can't touch it. Does that help you, Penny?
Yes, it does.
There you go. All right.
What's the best way to contact you?
Via email or phone.
Yeah.
Yep.
What's your
So
email address?
I'll flash it up in the chat, or maybe Donna, if you could do that, put my email in and but again, if you were invited here by someone else from Symmetry Equality, make sure you contact them. They can all do this too. Okay. All right. Let's see. I got a couple questions here in chat. You have no debt. 64. Oh,
You just answered that one.
right, Penny. All right, very
Yes.
good. Carrier loans. Okay. You have a limited use to pay bills. So a carrier loan. The carrier loan gets deposited into your checking account, whatever you use. Wells Fargo, Navy Federal, SunTrust, Bank of America, whoever uses your bank. That's where the carrier loan goes. What you do with the money is your choice. It's up to you. So you would then use that money to pay whatever whatever debt you're going to pay. I said this earlier in the presentation. I'll say it again. The critical reason why people in this program will fail is because they do stuff that a banker wouldn't do. Okay. So I may have $50,000 just sitting in my checking account, but I'm not lending it to my 19-year-old nephew to go open a bank, open a restaurant. I'm not doing it. Okay. I'll use it to pay off a debt while I have a debt, but I'm not doing it for silly stuff until I'm done and I don't need the money. So this is where you have to be diligent and you have to be disciplined. Spend the money only on the things you're supposed to be spending the money on. Now, that doesn't mean that you drop a transmission, Do you go buy a new car? Or do you fix the transmission? That's your choice. Either way, it's an appropriate use of the money. And that's one more thing I didn't illustrate this, but once you start these programs and they start building up the cash value, that debt snowball coupled with the infinite banking, with the regular compounded interest, with the regular dividend that comes in, you will get to the point, and it usually happens somewhere between 2.3 and 2.7 years, you don't need a bank anymore. You need a bank in order to write a check. Okay, so you always have a bank for that reason, but you don't need to borrow money ever again. And you know how this works. You've been around, you guys have been around long enough, right? When you need money and you need to borrow money, nobody wants to lend you money. And when you don't need money and you don't need to borrow money and your credit score is 800 plus, they trip over themselves trying to lend you money and you don't need the money. That's what happens. That's a byproduct of this. Your credit score is going to shoot up over 800 and you're never going to need credit again, because this is the golden rule, people. The person with the gold makes the rules. So I've got $50,000. I want to go buy a new car. Do I have to call up and see if I can get qualified for a loan? Nope. I walk into that dealership and say, hey, come here, buddy. See that car over there? That one that you've got that sticker for $28,000? I'm going to give you $20,000 cash and I'm walking out of here today with it. Are they going to hem and haw? No. He's going to go back and get his sales manager. They're going to figure out how they can take $20,000 cash from you today, and they're giving you that car for $20,000. That's the golden rule. And that's the additional, there's all kinds of esoteric benefits from these programs. Just the fact that you've got this, where it happens fairly quickly, this massive amount of cash available, it's a no-brainer. And this is something that I've seen it happen. It's happened to me, and it's awesome. Incidentally, program my wife and I are doing, 30 years in debt, 6.4, gone. Actually, it's faster now too. So this program will work for anybody. Even if you're 82 years old, you can still do a program, but you got to do an outside the box thought. Got to do it on a family member. Maintain control. Be the payer, be the owner, be the beneficiary. Don't give it to them until they're old enough to administer it for themselves. Over 18, don't give an 18-year-old $50,000 in a program, people. Don't do that. Okay, give it to the parent, unless the parent's worse, which I've seen also. So be appropriate. Okay, that happens all the time. So let's see if there's anything else. Yep.
Can you speak a little bit to how the process works for a carrier loan with the carriers
Sure.
we use? A lot of people are not familiar with how
Right.
could I take a loan out?
Are
Thank
you
you.
taking notes? Here it goes. You ready? Mr. Carrier, send $5,000 to my account. Thank you. There you go. It's a phone call or an email, or you type into your online portal, just like your bill pay, and say execute loan. Or in some cases, you have to fill out a form if the loan size is large enough.
It's a simple process. I
Yep.
do it online and they transfer the money. It's not like he's saying loan, but you don't have loan paperwork to fill out. It's just transferring the money.
The most you'll ever be is a one-page document where you got to put a date and a signature on it. Thanks, Dennis.
I got a question, Scott.
Yes, sir.
All right, so just to make this kind of simple terms, or I think simple terms. So say you're making, we'll say $5,000 a month. Out of that $5,000 a month, you need about $1,000 a month for spending money or whatever. So you have an additional $4,000 coming in each month that you would take and put into this program to pay for your bills, your credit card bills, your house payment, your car payment, everything. So say your house payment, your car payment are $2,000 and your credit card bills are $1,000. So that'll leave you an additional $1,000 in the program to build your program up, correct? And each month you would pull out $3,000 to pay your bills?
Nope. How much money you put into the program?
$4,000.
There you go. How much is the interest rate based on?
The what?
The interest rate is based on the money you're putting in,
Okay.
not the money you have unencumbered.
Oh, so you're making interest on the $4,000.
Yes.
And
Yes.
So then
You got it.
you're pulling out 3,000 each month.
But you're still making money on the 4,000 because you never touched your money. You
So
took a
you-
loan. Your money's still sitting there, churning and burning.
Well, you're calling it a loan, but you don't really ever pay that back.
Correct. But you
Correct.
can. So
Well, yeah,
this is-
if you had extra money.
yeah. Well, no. So don't get me wrong. There's a logical reason, and that's why I say every one of these programs is different. There's a reason why you may want to do what we call dollar cycling, which is where you are paying off that loan. Okay. Maybe you do, maybe you don't. It depends. And it depends on what the goal is. It depends on how you're going to use the program. It depends on what your long-term goals are. It depends on what your disposable income is. It depends on if you've got lump sums you're going to be dumped in. I've got a client that's got $1 million, just got $1 million inheritance. And she wants to do this program with that $1 million inheritance. You can't load $1 million in this in 1 year, but you can do it over 3. And then have that $100,000 left over to pay for the next 4 years minimum payments. So basically for $1 million, she's going to get $1.4 million in 7 years. That's earning her about $120,000, $130,000 a year every year for the rest of her life. She's and that $1 million will still be there because she's never touching the $1 million. Okay, so there's no, like I said, there's no one size fits all. It's whatever the client needs and whatever their financial situation is. You have to, all these things have to be taken into consideration. So this is
Customized.
yeah, exactly, big time.
Hey,
Okay,
Scott,
so
Scott, this is Tay. I think
Hey, Tay.
what he was saying like you take 3,000 out each month to pay you the bills. You're going to pay your monthly bills every month like you do now. This program is going to tell you when you're going to have enough money in your policy to take a loan out to pay that bill off sooner to save interest.
So that's true. That's absolutely accurate. The only difference is sometimes you can do this thing called dollar cycling, which means that you are, so if I make $6,000 a month, but my regular expenses are only $3,000, I'm going to put $6,000 in, I'm going to pull $3,000 out, put it back into my checking account, pay my monthly bills. And what I've just done is I've sequestered $6,000 every month. And in that scenario, over the course of a year, I made my $70,000. I've sequestered $65,000 or $75,000. I've paid all my bills. I've got these loans, but I'm doing dollar cycling. This is where we get into that conversation about, do I pay the loan off or do I take another loan? And this is where you have to look at, when you're structuring these, how much paid up addition life insurance. Remember, it's all based on PUA, right? How much paid up addition life insurance do I need to do whatever I'm going to use the program for? Yes, it's debt elimination. And if you've got debt, you can use it like that. What if you don't have debt? Well, you can use it just as a growth vehicle, or you can use it like we were just talking about today, a dollar cycling vehicle. I'm going to put $60,000 a year because that's what I'm making this year. I'm putting it all up into my private bank and I'm pulling it out and paying my bills as I need to. And in the end of the year, because I'm putting in 10,000 this month and taking out 2,000, I put in 10,000 next month, 8,000 is what it's going to be credited because I'm paying off that $2,000 loan. Here's the magic. Depending on the carrier that you use, some of them do monthly compounding. So if I'm on a carrier with monthly compounding, even though they charged me 1 year interest up front, they're going to credit me back 11/12 interest. So not only am I earning more money on my money because I'm getting paid 4% plus a dividend, right? And I'm being charged 4.7% as a loan, but because I only used 1/12 of that, the actual loan rate was only 0.3%. So even on that money that I've got in the program, I'm making 4.3% interest on that money for 1 month instead of whatever the major number is. It's a way that you can decrease the loan cost by doing dollar cycling.
Got it.
So there's a lot of different ways you can use it, but that's a great, and of course the debt-free is a no-brainer. Okay, but there's more uses, big time stuff like that. And that's really, I have a lot of business owners that are using it like that. You know, especially guys that flip houses and stuff like that. It's perfect for them.
I appreciate the information. I've got to go, but we've got a meeting tomorrow, right? We'll confirm that.
I believe so, yes.
All right, at 5 p.m.
I believe.
All right, thank you, sir. Appreciate the
thanks, Jim.
information.
All right, so we are now 2 minutes past. If anybody's got one more question, I'll take it. If not, we gotta get rolling on to the next piece. Everybody good?
Good.
Very
Okay.
good. Thank you.
Very good.
Talk
Thank
to
you,
whoever
Scott.
brought you here. Go start one of these programs on yourself. You can't go wrong with it. Bye, everybody. Have a great week.
Bye.
Thank you.
Bye, Scott.
Bye, guys.
Bye.